Tom Lee just said something that sounds completely counterintuitive. He believes the market is actually stronger today than when it was hitting all-time highs earlier this year. In this interview on CNBC Closing Bell, Tom Lee, Fundstrat's head of research and chief investment officer, breaks down why he thinks equities still have room to run, what a wartime economy really means for stocks, and the key forces driving the market right now. I'm going to play you the clip first, then I'll give you my full reaction and break down exactly what he got right, what investors might be missing, and how to think about this setup moving forward. After that, we'll dive into 4 wide-moat stocks that could benefit from this environment. Let's hear what Tom Lee has to say.
Tom Lee, he's Fundstrat's head of research, chief investment officer, also a CNBC contributor, and it's good to have you back. Welcome.
Great to see you, Scott.
Told us that you thought the bottom was in and that new highs were in reach. Now here we are. Now what?
I know this is going to sound counter to what the viewers might think, but I think the stock market is in a better position today than earlier this year when it made its all-time high. Because one, we're now seeing that the U.S. stock market can handle a surge in oil while it hurts other countries. We've seen earnings go up, so we now feel comfortable that the war is actually stimulating the economy. And the third is, I know I've talked before about inflation shocks, but we've been looking back at the history of oil spikes, and the impact on core is less than we thought. So I think there may be less of an inflation shock coming. So I think stocks can go back to that 7,300, which is our base case for this year in our three-phase market, before we might see a larger drawdown.
Well, I hear you essentially saying that the U.S., in some respects, as a result of this war, is the best house in a now more uncertain neighborhood.
That's right. This is the 7th black swan now thrown on investors since 2020. And now we've seen that the U.S. can handle a Middle East catastrophe, one where the strait is closed and oil's not available. The U.S. economy is still operating while other countries are talking about shutdowns and factories closing.
You don't feel in any way, or you're not concerned that you may be complacent to the risks that are still out there because of the war?
There are tail risks. I think that the size of the tail has shrunk, tail meaning a downside risk. And I do think that there's a lot of folks who are credibly pointing out that the shock could still hit the shore in the U.S. because of things like helium and other commodities. So we are watching that, Scott, but I'd also say that we could have a positive tail risk, which is if we can find a lasting ceasefire, then whatever shock hits the shores is so short in effect that it won't hurt our base case.
The NASDAQ is trying for its 11th straight positive day. It'd be the longest streak since November of 2021. There are those who believe, like JP Morgan does, that if the next leg of the rally is going to be strong, tech is going to have to lead. Do you agree with that call?
Yeah, we do. I think that it's still useful for people to look at what has outperformed since the war started. And, number one has been Ethereum and Bitcoin, which are crypto, but they're highly correlated to tech. Of course, there's energy stocks, but then it's led by tech, and the Mag 7, and even the software. So I think that JP Morgan's correct. I think tech is growth when people are worried about growth. And of course, it's also been the most under-owned group because that's the group people were selling.
Well, part of the call is that you're going to get the best earnings growth from tech. There are more notes about that today, while at the same time, valuations have fallen. So these stocks in some people's eyes aren't as pricey as they used to be and look even more attractive because earnings growth estimates are solid, if not increasing.
That sounds right, Scott. These companies have true moats. They've grown earnings consistently faster than the S&P. I think they're going to be one of the winners around AI. And you're right. To buy them at a market multiple means that 5 years from now, I think people are going to be surprised that they could buy them so cheaply.
All right, so let's break down what just happened in this interview because on the surface it sounds bullish, but underneath there are some really nuanced ideas that most people are going to miss if they just take the headlines at face value. What Tom Lee is essentially arguing here is that the stock market today is actually in a stronger position than when it was hitting all-time highs earlier in the year. And that sounds completely backwards at first. Most people assume uncertainty equals weakness. War, oil shocks, geopolitical tension, those are supposed to break markets, not strengthen them. But his argument flips that logic. He's saying the market has now been stress tested. Not hypothetically, but in real time. We've seen oil spike, we've seen geopolitical chaos, and yet the US economy and stock market are still holding up. In his view, that resilience actually increases confidence going forward, and I think this is where things get interesting, because historically, markets hate uncertainty more than they hate bad news. Once something bad actually happens, and the system absorbs it, investors can start to price things more clearly. So in a strange way, the shock itself can reduce fear. Now, one of his key points is about oil. Normally, a surge in oil prices would be a major red flag. It feeds inflation, squeezes consumers, and hurts corporate margins. But what he's saying is that this time, the US is handling it better than expected, especially compared to other countries. He paints this picture of the US as the best house in a bad neighborhood. And honestly, that's a powerful framing, because investing is always relative. Money doesn't just ask, is this good? It asks, is this better than the alternatives? If Europe or parts of Asia are struggling more with energy shocks, capital naturally flows toward the US. That alone can support stock prices even if conditions are not perfect domestically. But here's where I'd push back just a bit. Saying the war is stimulating the economy is a bold claim. There is some truth to it. Defense spending rises, certain industries benefit, supply chains shift, but calling it a net positive can be dangerous thinking if it makes investors underestimate long-term risks. Because wars are unpredictable, they don't move in straight lines, and markets have a habit of looking calm right before something breaks. Now, another major point he brings up is inflation. This is huge. He's basically saying that historically, oil spikes do not hit core inflation as hard as people think. And if that's true, it changes the entire narrative, because right now, inflation is the biggest variable driving interest rates, and interest rates are what drive valuations. So if inflation does not spike as much as feared, the Federal Reserve has less reason to stay aggressive, and that creates room for stocks to move higher. This is why he feels comfortable calling for the market to push back toward those previous highs, around that 7,300 level he mentioned. But again, I think this is where investors need to stay balanced. Markets don't just react to data, they react to expectations of data. If everyone starts believing inflation is under control and then it surprises to the upside, that's when you get sharp corrections. So the risk is not just inflation itself, it's being wrong about inflation. Now, when he talks about this being the 7th black swan event since 2020, that really stood out to me. Because what he's implying is that markets have built up a kind of immunity. We've had a pandemic, rate shocks, banking crises, geopolitical conflicts, and each time the system bends but doesn't break. And over time, that conditions investors to buy the dip faster and with more confidence. But there's a flip side to that too. The more people believe every dip will recover, the more crowded that trade becomes. And crowded trades are where risk builds quietly. Now, he does acknowledge tail risks, and I think this part is important because it shows he's not completely ignoring the downside. He mentions things like supply shocks from commodities, even helium, which most people don't think about. These are the kinds of second-order effects that can ripple through industries in unexpected ways. But what's interesting is that he also introduces the idea of a positive tail risk, and that's not something you hear often. He's basically saying if there is a ceasefire or some kind of resolution, then the entire shock could end up being short-lived, almost like a temporary disruption rather than a structural problem. And if that happens, markets could actually accelerate higher because uncertainty gets removed quickly. Now, shifting to tech, this is where the conversation gets even more actionable. He agrees with the idea that if the next leg of the rally is going to be strong, it has to be led by technology, and that aligns with what we've seen over the past decade. When growth is scarce, investors pay up for companies that can still grow, and tech, especially the big players, continues to deliver that growth. He points out something really key here. Tech has been under-owned recently because it was the group people were selling. That means positioning is lighter, and in markets, positioning matters just as much as fundamentals. If a sector is under-owned and the narrative starts to improve, you get this powerful combination of buying pressure and improving sentiment. That's how rallies really take off. He also mentions crypto, specifically Bitcoin and Ethereum, as leading indicators. And while that might sound surprising, it actually makes sense. Crypto tends to behave like high beta tech. It moves first, it moves faster, and it reflects risk appetite. So when crypto is leading, it often signals that investors are willing to take on more risk again. And then we get into valuations. This is probably one of the strongest parts of the bullish argument. Tech stocks have seen their valuations come down, while earnings expectations remain strong or even improve. That combination is rare. Usually, you either get strong earnings and high valuations or cheap valuations with weak growth. Getting both improving earnings and lower valuations creates a very attractive setup. And when he talks about these companies having true moats, he's referring to the durability of their business models. These are companies that dominate their industries, generate massive cash flow, and continue to innovate, so even in uncertain environments, they tend to outperform. Now, personally, I think this is where investors need to be selective. Not all tech is equal. The biggest winners are usually the ones with real pricing power, strong balance sheets, and global scale. Chasing anything labeled tech just because it's in the sector can backfire. So overall, Tom Lee's message is clear. He believes the market has absorbed a major shock, proven its resilience, and is now positioned to move higher, led by tech, supported by stable inflation, and boosted by relative strength compared to the rest of the world. But at the same time, there are still risks under the surface. And the biggest mistake investors can make is assuming that resilience means invincibility, because markets don't break when everyone is scared, they break when everyone is comfortable. And that's exactly why conversations like this matter, because it's not just about whether the market goes up or down, it's about understanding why people believe what they believe and where those beliefs could be wrong. Now let's dive in and break down the 4 wide moat stocks you can buy right now that are built to dominate their industries for the next decade and beyond. These are businesses with deep competitive advantages, powerful cash flow engines, and the ability to compound wealth quietly in the background while most investors chase noise. Let's start with the first one. Applied Materials, ticker symbol AMAT. If you strip away all the noise in the market right now, there is one undeniable truth. The world is becoming more dependent on semiconductors every single year. From artificial intelligence to electric vehicles to cloud computing, chips are no longer optional. They are the backbone of modern civilization. And here is the key insight most investors miss. The companies that make the chips get all the attention, but the companies that build the machines that make those chips quietly control the entire ecosystem. That is where Applied Materials sits. This is a company that supplies the equipment, software, and services needed to manufacture semiconductors. Without companies like Applied Materials, there is no advanced chip production. That gives them a structural advantage that is incredibly difficult to replicate. Think about it like this. If chip makers are the gold miners, Applied Materials is selling the tools that every miner needs regardless of who strikes gold. That is a powerful position to be in. Their moat comes from a combination of technological complexity, long customer relationships, and extremely high switching costs. Once a semiconductor manufacturer integrates Applied Materials equipment into its production line, it is not something they casually replace. The cost, risk, and time required to switch are enormous. That creates sticky, recurring demand. Now let's talk about why this matters today. We are entering a phase where demand for advanced chips is accelerating. Artificial intelligence alone is driving a new wave of capital spending across the semiconductor industry. Data centers are expanding, high-performance computing is scaling, and governments are investing heavily in domestic chip production for national security reasons. All of this translates into more demand for the tools required to build these chips. Applied Materials is positioned directly in the middle of this trend. According to recent data, the company continues to generate strong revenue and maintains healthy margins, supported by both equipment sales and a growing services segment. That services business is especially important because it creates recurring revenue streams that smooth out the cyclical nature of semiconductor spending. This is not just a one-dimensional business tied to boom and bust cycles. It is evolving into a more stable, cash-generating machine. Another thing that stands out is their investment in research and development. This is a company that spends heavily to stay ahead of technological shifts. That is critical in an industry where innovation cycles move fast, and staying behind even slightly can mean losing relevance. Applied Materials has consistently shown the ability to adapt to new manufacturing processes, which reinforces its competitive position. Now let's talk valuation and opportunity. Wide-moat companies rarely trade at deep discounts unless there is some level of uncertainty in the market. And right now, concerns around global demand, geopolitical tensions, and semiconductor cycles have created pockets of opportunity. That is exactly where long-term investors should be paying attention. Because if you believe that semiconductor demand will continue to grow over the next decade, and it is hard to argue otherwise, then owning a company that enables that entire ecosystem becomes a very compelling idea. But here is my personal take. This is not a stock you buy expecting quick gains. This is a business you hold because it sits at the foundation of multiple long-term trends. It is the kind of company that benefits from every wave of technological progress without needing to predict which specific company wins. And that is a subtle but powerful advantage. Instead of betting on which chipmaker dominates, you are investing in the infrastructure that supports them all. That is what makes Applied Materials a true wide-moat business. And in an environment where markets are volatile and narratives shift quickly, owning companies with that level of structural importance can provide a different kind of confidence. Because at the end of the day, the world cannot move forward without what they provide. If this resonates with you, you're exactly who this channel is for. Please hit the like button, share the video, and leave your thoughts in the comments. Subscribe to the channel so you don't miss out on the next important financial investing update. Remember to do your own research before you invest in any stock. Now let's move to the second company, and this one operates in a completely different space, but with just as much dominance and long-term staying power. Intuit, ticker symbol INTU. At its core, Intuit sits at the intersection of money, data, and decision-making. And that might sound simple, but when you really think about it, that is one of the most powerful positions any company can have. Because every individual, every small business, and even larger enterprises need to manage their finances. They need to track income, expenses, taxes, payroll, and cash flow. And once they find a system that works, they almost never switch. That is where Intuit has built its moat. This is a company that has embedded itself deeply into the financial lives of millions of users. Its ecosystem spans tax preparation, accounting software, and personal finance tools. And the deeper a user goes into that ecosystem, the harder it becomes to leave. Switching costs are not just about money here. They are about time, familiarity, and trust. Think about someone who has used the same platform for years to file taxes or run their business finances. All their data is there, their processes are built around it. Moving to a new system is not just inconvenient, it is risky. That is a powerful retention driver. Now layer on top of that the shift toward digital and cloud-based solutions. More businesses are moving away from spreadsheets and manual processes and into integrated platforms. Intuit has been a major beneficiary of that transition. Its cloud offerings continue to grow, and that creates recurring revenue streams that are far more predictable than one-time product sales. This is where the business really starts to compound. According to recent data, Intuit continues to deliver strong revenue growth, driven by its core segments and expanding user base. Its margins remain robust, reflecting both pricing power and operational efficiency. And here is something that stands out to me. Intuit is not just maintaining its position, it is actively expanding its ecosystem. By adding new services and capabilities, it increases the value of staying within its platform. That creates a network effect where the more you use it, the more valuable it becomes. This is exactly what you want to see in a wide-moat business. Another important factor is the role of data. Intuit has access to an enormous amount of financial data across individuals and businesses. That gives it the ability to develop insights, automate processes, and improve user experiences in ways that competitors struggle to match. As artificial intelligence becomes more integrated into financial tools, this data advantage could become even more significant. Now let's talk about why this matters in the current environment. Economic uncertainty tends to put pressure on businesses, especially small businesses, but it also increases the need for better financial visibility and control. Companies want to understand their cash flow, manage costs, and make smarter decisions. That plays directly into Intuit's strengths. Instead of being a cyclical business that rises and falls with the economy, it becomes more of a necessity, and that is a key difference. Now here is my personal take on Intuit. This is one of those companies that does not always get the same attention as high-growth tech names, but it quietly delivers consistent performance. It is not flashy, but it is incredibly effective, and sometimes those are the best investments, because while others chase the next big thing, companies like Intuit just keep compounding in the background. They build loyal user bases, expand their offerings, and steadily grow their cash flow. That is how long-term wealth is often built. But there is also something to watch here. Because Intuit is so dominant in its space, expectations are naturally high. And when expectations are high, even small disappointments can lead to volatility in the stock. So while the long-term story remains strong, investors still need to pay attention to valuation and execution. That said, when you combine strong brand recognition, high switching costs, recurring revenue, and a growing ecosystem, you get a business that is very difficult to disrupt. And in a market where durability matters more than ever, that kind of stability is extremely valuable. If this resonates with you, you're exactly who this channel is for. Please hit the like button, share the video, and leave your thoughts in the comments. Subscribe to the channel so you don't miss out on the next important financial investing update. Remember to do your own research before you invest in any stock. This video is brought to you by Value Stocks Investing Master Course. If you're looking to grow your wealth by investing in solid, undervalued stocks but not sure where to start, I created the Value Stocks Investing Master Course to teach you how to identify great companies, make smart investment decisions, and build a portfolio that lasts. Click the link in the description and pinned comments to get the course today and take control of your financial future. Now let's move to the third company, and this one is a perfect example of a business that quietly powers the modern world without most people ever thinking about it. Texas Instruments Incorporated, ticker symbol TXN. When people hear semiconductors, they often think about cutting-edge chips used in artificial intelligence or high-performance computing. But there is another side of the semiconductor industry that is just as important, and in many ways more stable: analog chips, and Texas Instruments dominates this space. Analog semiconductors are used to process real-world signals like sound, temperature, pressure, and power. These chips are found in everything from industrial machines to cars to consumer electronics. They are not flashy, but they are essential, and here is what makes this business so powerful. Unlike advanced processors that go through rapid innovation cycles, analog chips have extremely long product life cycles. Once a chip is designed into a system, it can stay there for years, sometimes even decades. That creates a level of stability that is rare in the semiconductor industry. Texas Instruments has built its moat around this exact dynamic. The company has one of the largest portfolios of analog products in the world. It serves tens of thousands of customers across a wide range of industries. And because its chips are so deeply embedded in these systems, switching costs are incredibly high. This is not a business where customers constantly jump from one supplier to another. Reliability matters more than novelty. Now let's talk about scale. Texas Instruments operates with a manufacturing strategy that gives it a cost advantage over competitors. The company has invested heavily in its own production facilities, allowing it to control costs and maintain high margins over time. That is a big deal, because in a cyclical industry like semiconductors, the companies that can produce efficiently and maintain profitability through downturns are the ones that come out stronger on the other side, and Texas Instruments has proven this over and over again. According to recent data, the company continues to generate strong free cash flow and returns a significant portion of that cash to shareholders through dividends and buybacks. This is not just a growth story, it is also an income and capital return story. That combination is very attractive for long-term investors. Another important factor is diversification. Texas Instruments is not dependent on a single end market. It serves industrial, automotive, and consumer segments, which helps balance out demand fluctuations. When one area slows down, another can pick up. This reduces overall volatility in the business. Now let's connect this to the bigger picture. We are seeing a global push toward electrification, automation, and smarter systems. Cars are becoming more electronic. Factories are becoming more automated. Devices are becoming more connected. All of these trends increase the demand for analog chips. And Texas Instruments is right in the middle of that. This is not about chasing the latest technology trend. This is about owning the infrastructure that supports multiple trends at once. That is what makes it a wide moat business. Now here is my personal take on Texas Instruments. This is one of those companies that rewards patience. It is not going to double overnight. It is not going to dominate headlines, but it consistently generates cash, returns value to shareholders, and strengthens its competitive position over time. And in a market where uncertainty is high, that kind of reliability becomes incredibly valuable. But there is also something investors need to understand. Because of its stability and strong track record, Texas Instruments often trades at a premium. Investors are willing to pay more for predictability. So the key is not just recognizing the quality of the business, but also being mindful of the price you pay. Still, when you look at the combination of long product cycles, high switching costs, diversified end markets, and strong cash generation, it is clear why this company is considered a wide moat stock. It is deeply embedded in the systems that keep the modern economy running. And that is not something that changes overnight. Now let's move to the final company, and this is one that almost feels too obvious, yet at the same time still massively misunderstood in terms of its long-term power. Microsoft Corporation, ticker symbol MSFT. This is not just a software company. This is one of the most deeply embedded platforms in the global economy. When you think about wide moat businesses, you are looking for companies that are not just leaders, but companies that are almost impossible to replace. And Microsoft sits at the center of multiple critical systems that businesses rely on every single day. enterprise software, cloud infrastructure, productivity tools, and now artificial intelligence. That combination is incredibly hard to compete with. Let's start with the moat. Microsoft's dominance comes from ecosystem lock-in. Businesses around the world rely on its products to operate. From operating systems to office productivity tools to cloud services, everything is interconnected. Once a company builds its workflows around Microsoft's ecosystem, switching becomes extremely costly and disruptive. It is not just about replacing one product, it is about reworking entire systems. That creates a level of stickiness that few companies can match. Now layer on top of that its cloud business. Cloud computing has become one of the most important pillars of modern technology, and Microsoft has positioned itself as a major player in this space. Its cloud platform continues to grow rapidly, driven by enterprise adoption and the ongoing shift away from on-premises infrastructure. This is not a short-term trend, this is a multi-decade transformation, and Microsoft is right in the middle of it. According to recent data, the company continues to deliver strong revenue growth across its segments, with cloud services being a major driver. Its margins remain robust, supported by scale and operational efficiency, but what really stands out right now is its position in artificial intelligence. Microsoft has aggressively integrated AI into its products and services, enhancing everything from productivity tools to cloud offerings. This is not just about adding features, it is about increasing the value of its entire ecosystem, and here is why that matters. AI has the potential to significantly boost productivity and efficiency for businesses. If Microsoft becomes the platform through which that productivity is delivered, it strengthens its moat even further. This creates a flywheel effect. More users lead to more data. More data leads to better AI capabilities. Better capabilities attract more users. And the cycle continues. That is how dominant platforms extend their lead. Now let's talk about capital allocation. Microsoft generates massive amounts of cash, and it uses that cash strategically. It invests in growth areas, returns capital to shareholders, and maintains a strong balance sheet. This gives it flexibility. In times of uncertainty, companies with strong balance sheets have the ability to invest while others pull back. That often leads to gaining market share and strengthening competitive advantages. Now here is my personal take on Microsoft. This is one of the few companies that has successfully reinvented itself multiple times. From its early days in software to its expansion into cloud computing and now its push into AI, it has shown the ability to adapt and lead through different technological eras. That is not easy to do, and it is one of the reasons why it continues to be relevant at such a large scale. But there is also a reality investors need to consider. Because Microsoft is so widely recognized as a high-quality business, it is often priced accordingly. That means expectations are high, and when expectations are high, execution becomes even more important. So while the long-term story is strong, investors still need to be disciplined. That said, when you combine ecosystem lock-in, cloud growth, AI integration, and strong financials, you get a business that is built to compound over time. And that is exactly what long-term investors should be looking for. Now, when you step back and look at all four of these companies together, a clear pattern starts to emerge. Applied Materials powers the semiconductor manufacturing ecosystem. Intuit owns the financial operating systems for individuals and businesses. Texas Instruments dominates essential analog chips that run everyday systems. And Microsoft sits at the center of global software and cloud infrastructure. These are not just companies, these are foundations. Each one has built a moat that protects its business from competition and allows it to generate consistent returns over time, and that is the key takeaway here. In a market full of uncertainty, the companies that tend to win are the ones with durable advantages, strong cash flow, and the ability to adapt to changing environments. If you want exclusive stock tips, in-depth analysis, real-time trade alerts, and free investing guides, join the Stocks Galore Patreon today and take your investing game to the next level. Our members get full in-depth analysis on most of the stocks mentioned here. Head over to patreon.com/stocksgalore and become part of our growing community of smart investors. Link is in the description. Now I want to hear from you. Which of these companies do you think has the strongest long-term advantage, and which one would you feel most confident holding for the next 10 years? Do not forget to like the video, share your thoughts in the comments, and subscribe so you do not miss the next important investing update. Thanks for watching, and I will see you in the next one.